Real estate investment trusts, are commonly referred to as REITs for short, are a great way to compound wealth over the long term because they bring all the benefits of real estate, namely the cash flows, the benefit of cheap and conservatively structured leverage, the underlying appreciation of the real estate itself, as well as organic growth that's driven by inflation, as well as economic growth on the rental income from the asset itself. Additionally, REITs, though, add to that many benefits such as enhanced diversification that would be virtually impossible for an individual investor to replicate, professional management, lower cost of capital, access to unique deal flow and even sectors that, again, the average investor would not have access to, and many others, including instant liquidity if you're investing in a publicly traded REIT, whereas and indivisibility as well. You can sell a single share for only a few dollars, whereas to transact in physical real estate, you have to transact typically in individual properties at a time, which are much more elaborate. You have to go find a buyer. You have to find a managed tenants. You don't have to worry about any of that with publicly traded REITs. That being said, there are some unique pitfalls that are unique to the REIT sector that regular individual real estate investors or regular stock market investors potentially may not even have to deal with. And so in this video, I'm going to discuss what those are to help you avoid those pitfalls when investing in the REIT sector. But before I get into today's video, if you could please give it a like, I'd really appreciate it. Thank you very much. Okay, so what is the biggest lesson that I've learned that from investing in REITs that I wish I had known before investing in REITs? Well, one of the four that I want to share with you today is simply the fact that finding well-aligned management is absolutely essential. This is because many times REITs are actually externally managed, which means that the REIT pays a fee to an asset manager to manage the REIT on behalf of the shareholders. And many times these external managers really don't care about shareholder value. They have very low exposure to the REIT themselves. Management's not very well aligned in that sense, and they just want to grow the REIT at all costs. They'll issue shares on a non-accretive basis to acquire more assets, leverage it up, and then they'll charge a fee on the gross assets just to enrich themselves at the expense of the shareholder. GNL is a company, Global Net Lease, that in the past was externally managed, and they were a tragic example of this. They've since become internalized. They still have some issues they're working through, but in the past they were a classic example of what this sort of REIT to avoid looked like, and they destroyed a lot of shareholder value in the process. Another area you have to look at in this regard is even if it's internally managed, many times management teams will have a different view of how they're going to create long-term shareholder value than the individual shareholder. So for example, WP Carey is a recent example of this. They had an attractive dividend yield that they'd grown for about a quarter century. It was well covered by cash flows. It was backed by a BBB plus credit rating, well-diversified portfolio of triple net lease, high-quality assets that generated very stable cash flows. However, management decided out of the blue, only a few weeks after hiking the dividend, that they actually decided to cut the dividend pretty meaningfully. And this was because they wanted to increase their amount of retained cash flow in order to support their rapid exit from the office space and to be able to invest more aggressively in their pivot towards becoming a nearly entirely pure play industrial warehouse REIT. And so by retaining more capital, they can invest more aggressively in capturing these growth opportunities that they found. Whereas many investors had bought the stock because they viewed it as an attractive and very dependable yield. And so there was a conflict there between what shareholders were wanting and what management was wanting, even though it was internally managed. And so you just have to be aware of that when investing. You need to realize that management may not always see things the same way you can. That's why I personally, at High Yield Investor, we interview management teams, try to get the best sense we possibly can. We're not perfect, but it has helped us to avoid a few dividend cuts by doing that. Otherwise, look at their track record and diversify, because again, you just never know how management's going to act. That's something when you're managing your own real estate, you don't have to worry about that, or even many other stocks may not be quite as subject to such unique things because REITs have to pay out 90% of their taxable income as dividends, and so they're a little more cash flow constrained. And so if there's a way they can cut it and still meet that threshold, they often will. Not in many cases they won't, but in many cases they will. So you just have to be aware of that when investing in REITs. Another lesson that I wish I had learned before investing in REITs is that even though their underlying performance in terms of their cash flows and even their balance sheet stability is often not that sensitive to interest rates, especially if it's a well-run REIT with a good balance sheet and a stable business model with long-dated cash flows, such as Realty Income, for example, then, that kind of business is going to do quite well in a rising or falling interest rate environment in terms of just generating stable cash flows. And their balance sheet will be in solid shape. However, the stock price often fluctuates wildly, and you've seen this with Realty Income. When interest rates rose aggressively from 2022 till recently, the stock price underperformed significantly. And then in recent weeks and months, when interest rates have started to come down again, the view is that the Fed's going to pivot to cuts here very soon. You've seen the stock price recover sharply. Why is that disconnect? Well, two things. One is the net present value of their cash flow. So triple net lease REITs like Realty Income have leases that last 10, 20, maybe even more years. And so so they also have contractual rent increases on those leases. And so when you combine that, you have a very stable, predictable cash flow stream that's kind of bond-like in nature. And in fact, many investors view stocks like Realty Income as bond proxies, bond substitutes. And so when interest rates rise, the market demands a higher dividend yield, a higher FFO yield from a stock like that. And therefore, the stock price tends to decline to provide that yield, that to push the yield higher. There's another reason why, however, interest rates have such an impact on public stocks, and that's simply because the market tends to overreact both to good news and bad news and is forward-looking in nature. And so if you have an environment where the sentiment is higher for longer interest rates, the market is not only going to adjust Realty Income stock price to adjust for where the yield should be relative to bonds at the moment, but many times it actually gets ahead of itself and thinks, okay, well, if interest rates are going to be high for the indefinite future, maybe long-term rates will even go up higher, then they're concerned that, well, maybe eventually Realty Income will have to refinance a bunch of its debt at a much higher interest rate, and so that's going to wear on the cash flows. Oh, and maybe it's also going to reduce the growth rate for the company because the cost of capital is higher, and so therefore, its future outlook is not as good as it thought to be, and so that's going to further weigh on it. And then there's also a lot of algorithmic momentum chasing dollars. For example, in recent years, a lot of money has fled more bond-like, defensive, boring companies like Realty Income and gone into high-flying tech stocks like NVIDIA and Microsoft, chasing the AI money, the AI boom. And so that further compounds the process. Computers are in there saying, oh, this stock is going down. We're going to bet it's going to keep going down, so we're going to short it or sell it, and we're going to go into these momentum stocks going higher, and that further compounds the disconnect. And so this is important for investors to know, because when you're investing in REITs, you need to be prepared for that. And so if your stock goes out of favor, you need to focus on the underlying fundamentals. Even if the stock just gets beat down 40%, 50%, that's happened to high quality REITs, but focus on the thesis. Is the dividend safe? Is it still growing at a rate that meets or beats inflation or whatever reason you bought it for? Is that still intact? Is the balance sheet on firm ground for the foreseeable future? Do you trust management? Are they executing the strategy that you believe they would when you bought the stock? If all those things maintain in place, there's no reason to sell if you're a value investor like I am with a long-term outlook. In fact, it's often a reason to buy more, in fact, to take advantage of that market disconnect. And the reverse is true. When suddenly interest rates are falling, the market is maybe concerned about a recession, or maybe AI is finally falling out of favor and people are pouring money into REITs and other stocks like that. Realty Income is going to go up, and it may even go up to a very significant premium to the underlying value of its real estate and its historical valuation multiples, because the market is now suddenly very bullish on it. You've got algorithmic trading going on. You've got momentum chasers. You've got all these funds trying to put it in their portfolio because it's a hot stock, etc. And so those are good times to sell your Realty Income shares to take advantage of that market bullishness and recycle somewhere else. And then you can always cycle back in to Realty Income later on once interest rates go up again, or the Realty Income stock and the triple net lease sector in general maybe falls out of favor. So that's another important lesson to keep in mind as you approach the sector from a value investing perspective. Another big lesson to keep in mind is that the business model durability and the balance sheet quality are arguably the two most important things to look at before investing in a REIT. Many people think real estate is just general real estate, and so they just use cap rates and other numbers, and they think it's just a big math equation. It's all going to work out the same. But very seldom that any two REITs are exactly alike, especially where there are two different sectors. For example, Simon Property Group and Mid-America Apartment Communities and Realty Income are three very different REITs. Simon Property Group primarily owns Class A malls, retail real estate. They own some outlet centers as well. And you have Mid-America Apartment Communities, is focused on multifamily apartment complexes. And then you have Realty Income, which is focused on single-tenant, freestanding, triple net lease properties. And so it's three very different industries that they operate in, three different business models. And so they're not apples to apples comparisons. You should compare them to peers within their sector, not with intersecting sectors. And so when you look at each of those, it's really important to see, okay, do I understand the industry in which they operate, the sector? Is it sustainable and that they have the business model? And two, is their balance sheet strong enough to withstand any challenges that may come their way? For example, Simon Property Group faced some serious headwinds over the past 5 to 10 years with Amazon and the rise of e-commerce significantly disrupting the retail sector, especially physical retail stores were now no longer quite as valuable because a lot of purchases could be made online with shipping direct to people's homes. And so malls in general began to fall out of favor, and Class B and Class C were hit especially hard, while Simon Property Group and Macerich and a few others were able to weather these headwinds fairly well because their properties were in better locations, had better tenants, were more attractive to visitors, to customers. They were able to transform them, redevelop them into entertainment-focused properties, etc. And so Simon Property Group was able to weather that storm pretty well because it had a higher quality business model and it had a stronger balance sheet. It had a very strong balance sheet and was able to use that extra liquidity and flexibility to invest very aggressively in its properties, to repurpose them, make them multi-use, mixed use with work, live, play locations with some offices, some multifamily apartments, and repurposing the mall itself into maybe more of an entertainment-driven space, keeping it fresh and attractive for customers. And so that's an important example. Another example of a company that had a business model that perhaps is sustainable over the long term, hospitals, for-profit hospitals, medical properties trust. Hospitals are essential, right? You're always going to need hospitals of some kind. Many of MPW's properties are quality, very profitable, attractive hospitals. However, they had a leaky balance sheet and also troubled tenants. And so when those tenant difficulties rolled in, and they continue to roll into this day, MPW did not have nearly the flexibility that, say, a Simon Property Group did to deal with those headwinds. And so they've had to slash their dividends several times. They've had to sell off a lot of assets, had to focus on paying down debt. And so shareholders who bought initially before these troubles surfaced have gotten crushed. The dividend has been decimated. The share price has collapsed. Shareholder value has been destroyed. And so, again, looking at the balance sheet strength as well as the business model durability are two essential components to ensuring that your value can be not only sustained, but even created over the long term, and your dividend along with it. Okay, the fourth and final lesson that I wish I had learned before investing in REITs is simply the fact that you have to understand what the story is for creating long-term value for you as a shareholder. And really, there are two common stories with REITs. There's the deep value thesis, where the REIT trades at a deep discount to the underlying value of the real estate, or what that real estate would trade at on the private market. And then the second one is really more of a dividend plus growth strategy, where you look at the REIT's dividend and their projected growth rate, and you can add those two together and determine, okay, I think it's going to deliver attractive total returns over the long term, especially if you think that it's somewhat undervalued. You can potentially factor in some valuation multiple appreciation. Although I personally, unless it's a deep value NAV story, I generally do not like to rely on market favorability when doing my investment analysis, because again, you never know where the market's going to go. That's largely subject to interest rates and sentiment and other things that are beyond your control, and those things can go for a long period of time. So if I'm looking at the dividend plus growth model, I like to know that, am I going to get a satisfactory return from just the dividend and growth, and I don't need market favorability. That's merely, it would be a cherry on the top. And so when you're looking at the NAV story, some things to really keep in mind are really, how is that NAV going to be unlocked? Are you a believer in the story? I've made some mistakes even outside of the REIT space doing this pursuit, where I see some of the parts of the valuation of the business, and I see it's at a discount to peers, a meaningful one. And I say, okay, maybe there's an activist investor involved, maybe there's a strategic review going on, and you think, okay, they're looking to sell the business. But you really need to know, are they desperate to sell the business? Because if they're desperate, if they're time constrained, they maybe end up in a situation where they're forced to sell at a price that is less than desirable, because if they don't, they're going to have to cut the dividend, they're going to face financial difficulties or some other issue. So you want it to be from, if it is a sale-based unlocking of the value, you want to be from a position of strength where they can say no indefinitely and continue just running the business as is, and they're only going to say yes if it's truly an attractive deal that's going to create a lot of value for shareholders. The other thing you need to look at is the management aligned with shareholders? Are they incentivized to get a really good deal for you, or are they just looking to, sell off some assets just to check the block, or maybe even their compensation sets them up where they benefit from that? So again, you want to make sure that their interests are aligned with yours. And finally, you need to look at, what is the current environment like? For example, Farmland Properties Trust is a REIT currently that trades at a deep discount to its net asset value. So you need to see, okay, how are they going about trying to unlock this value? Like I said, well, in the case of FPI, they've been selling off farms and using the proceeds to pay down some debt, but also to buy back a lot of shares at a steep discount to NAV. And by doing that, they're trying to unlock value for shareholders. And that's great, but you need to realize, what is the time horizon where they're going to really be able to sell off enough meaningful farmland to really make a meaningful impact here to unlock value? Or is there even a chance that they could sell the entire REIT to an investor to really unlock a lot of value quickly? Or is this merely just a token amount of buybacks that they're doing just to try to tell the market that they're undervalued, but they're really not doing anything meaningful? And as a result, you as a shareholder are likely going to be looking at an indefinite period of underperformance relative to the market. So these are things you need to look at. Obviously the multifamily space is an interesting place right now, because alternative asset managers like Blackstone and KKR have been buying up apartment REITs quite aggressively, and even some single family ones like Tricon. And so if you're going to buy into a multifamily REIT that trades at a meaningful discount to NAV, especially if it's undervalued, valued to a good deal, then that's a potential that you could, get some quick upside from an acquisition, but you need to look at the markets they're in and try to understand that all a lot better. So hopefully that is useful to you. Hopefully these 4 lessons that I've learned the hard way, you've learned them now from this video so you don't repeat them. And I can't emphasize enough putting in the due diligence to try to understand the management as well as you can and the balance sheet as well as you can, because if you can avoid unpleasant surprises on those 2 fronts, that's going to deal with a lot of your issues, especially in the real estate investment trust sector where managements are often less well aligned than they are in other sectors, and balance sheets tend to be a little more leveraged than they are in other sectors. And so those are 2 of the big risks that you should keep in mind. So again, if this video was helpful for you, if you could please give it a like, subscribe to my channel so you can get future content, and finally let me know in the comments below what you thought of these 4 lessons and any you'd add to them, as well as if there are any REITs that you like right now. Thank you very much. See you next time.